Hello, everyone. So before we start, we just met Ashwin outside, and he just he just perfectly described this panel. He called it insider trading. We have Kamal here from Morgan Stanley, along with Ranjal from Emeritus, Eruditus, and I'm from Mars, Nawaz. So maybe we should start with introducing ourselves. For those of you who don't know us, maybe we should start with Kamal, and then we'll delve into the topic more.
Sure. So that everyone is clear, the gentleman on the right is the one who has provided capital to both the gentleman on the left. And thanks to the earlier panel, it feels really good that we didn't start at 4:20. Otherwise, people might have said 420 wala panel. I'm Kamal. I head Morgan Stanley's investment banking business in India. Been with the firm for 25 odd years. The reason I have the pleasure of their invitation is I spend a lot of time with high growth companies across sectors, tech entrepreneurs, especially as they're early in the journey, and just guide them through the journey to a potential capital raise, debt equity, and a potential IPO. Then they can pay the fees I want for the service I provided over the years.
So we have the pleasure of Kamal advising us also. I am CFO of Emeritus Eruditus, and as Kamal mentioned, we've taken some money from Mars. Nawaz has been very instrumental in helping us on that. Again, been in this role for 5 odd years, and before that I was an equity investor. So it's a small world from equity investing to now raising private credit.
Yeah, we'll delve into that. We'll go into that. So for the benefit of everybody, hi, my name is Nawaz. I'm from Mars Growth Capital. We've had an excellent relationship with Eruditus for 3 years now. Morgan Stanley so that is more important. We are actually a MUFG fund, so that's the relationship between us and Morgan Stanley. So why don't we just go into the topic? It's a very dry topic. You know, everybody talks about credit. Maybe we should use the term debt, and we should talk about debt and Edtech and all those things. But Pranjal, first we start with you. Your latest fundraising. What can you tell us about it?
Yeah, so I think it's public. We raised a round which closed in October last year, which was an equity round. As I was discussing with you, Nawaz, I think what one lesson learned is that as you get increasingly in the growth stage, you start to get more and more associated with how the public markets behave. And so, equity raising bar keeps on rising. So I think that's the key lesson here. So the kind of funds who come in at this stage expect you to start having a performance and governance standard, which is getting closer and closer to what public markets expect, which in turn means longer cycle to raise capital, which also in turn means that your internal reporting systems, etc., all of that become more predictable. The governance structures are stronger, all of that. And I think, again, maybe segueing into that, I think and we'll talk about it in a bit, one of the advantages or byproduct that I was sharing with you of raising private credit or debt is that you actually have that discipline of, ensuring that you're reporting your numbers, obviously, accurately. But that's hygiene, of course. But more importantly, the frequency of it, watching out, how the numbers are stacking up, and the covenants, etc. around it. I think that's very important. So I think when we raised debt about 2.5 years back from you guys, the first 1 year, honestly, was a learning curve for us because in general, lenders ask for more kinds of reporting, including what they call as Dhaka, which in Hindi, you know what it means. But basically, they can actually go ahead and take your money if they want to, in some sense, right? But beyond that, it's also
My
just
legal's favorite word, DACA.
yeah. But beyond that, I think it's all about ensuring that you're giving the right comfort. And I think that goes a long way in terms of just, improving our discipline. And that helped in our fundraise. But like I said, it increasingly becomes more important.
I'll go on to the next question, but before going there, I want to go on record and say that Pranjal is a great CFO, but a very bad panelist. He literally took out my next question. So I'm now having to wonder, while I'm sitting here, what's my next question? You know what I mean? But anyway, going to Kamal. Kamal, you're someone who is at this intersection of public markets and private markets. You're seeing how things have been panning out over the years, last few years especially. What's your general view on the market right now? And once, as you're explaining, if you can also take us through what you're seeing, the Edtech sector, how you see the Edtech sector doing in that, capital piece thing. And then we'll also go into one point which Pranjal mentioned around difficulty for growth companies, growth stage companies to raise equity, right? And probably what I and Mars and Liquidity, we'd like to define as a growth funding gap, especially in Asia. So maybe we go into some of these topics and then we take it from there.
Sure. So borrowing from Charles Dickens' Tale of Two Cities, I coined this term called Tale of Three Cities, because you wake up in the morning, you read Economic Times or Business Stand or whichever business paper you go to. The headlines will make you believe that there is no better market on this planet than Indian markets. Sensex or Nifty 50 are hitting a high every couple of days. So I would say that's city one. Very constructive markets in India. If you are a listed company and you have delivered a track record of performing, and investors can gauge how you'll perform, revenue growth, margins, they're willing to price that risk at the finest level. So think about some of the largest investors, Vodafone, Blackstone, Carlyle, being able to sell down listed company positions worth billions of dollars at sub 1% discount, because the investor who's buying can price that risk very finely. The second city is the IPO markets. Yes, it's a fact that India is probably one of the only two markets on this planet where you can get an IPO done. The second market is US, broadly defined. There was a brief period where Japan was the third market. But India is firmly one of the two markets where you can get an IPO done. At the same time, there is a price or a toll you need to pay to get an IPO done. And that's the second city, which means an IPO is really tough. For someone who does that for a living and who has to pitch to a company every once in a while for them to go IPO so that I can collect my fees, it's a really tough product today. Investors are asking for a higher discount to price that risk because they see the markets are being volatile. They know companies will miss their quarters once they list. And it's very natural. Your factors, internal, external. And then there is a third city, which is private growth markets, where investors are saying, for us to give you a growth capital, equity or debt, we will price you off the potential IPO price. So there is discount one, which gets you from city one to city two. There's a second discount which gets you from city two to city three. So that's the state of the market. At the same time, I would say secondary markets, very constructive. IPO markets open. As you're a founder or an investor, paying that toll to get into the market may be actually a healthy thing, because think about the IPOs we did in 2024. We have done more IPOs in 2024 as Morgan Stanley than we have ever done in our history. All of those IPOs except one traded up, call it 20 to 30%, which means day 1, day 30, day 60, investors made money. What that means is they remember the founder, the CFO, very fondly, which is important because finally, all of you are building businesses, you care about the brand you're building for your customers, users, consumers, enterprises. Think about public markets as a key stakeholder. You need to create a brand from day one, which is your listing day. So if you have delivered the right return, you're creating a good brand. And because you're creating a good brand, when you want to go back to the market to raise capital next time, you will get the positive reception. Like Pranjal likes Nawaz right now, you want the public market investors to like you when you go back into the market for a fundraise. Could be for an acquisition, could be for growth.
Yeah, that's a very interesting point. And I want to actually focus on these 2 points that now, Kamal, you just mentioned about what are the positives, right? The positives in the market around Edtech. Also, Pranjal, you just mentioned about your fundraising story. And I want to merge and try and make a story out of it. So I want to understand, how do you see Eruditus's IPO plans in this market right now? What's your thinking, high level?
Yeah, I think, look, again, just what Kamal said, right? I think we want to be very deliberate and measured because for us, IPO is not the end game. It's actually start of another journey, right? And if you, our founders, Ashwin, Chet, etc. They are here for another few decades running the businesses. So I think in that context, I would say that 2 things. I'll say private equity fundraise, maybe not anymore. Private credit, yes, if you can give us more. And now, given our performance and everything else, I think IPO is the next step, but it will take at least a few years for us. Now, whether that's 3 years, 4 years, we don't know, but a few years.
I can see that Kamal has a comeback.
Yeah, I wanted to thank Nawaz for asking that planted question. I wanted Pranjal to say, we are going to IPO very soon, so I'm disappointed. But at the same time, that's a great question, and it's a very natural question to ask. The fact is, Google was probably the last search company to IPO and list in 2004, which, if you are old enough like me, you will remember that there were multiple search engines before Google. Today, really none exist. And the reason Google went public in 2004 was they had crossed the number of shareholders through ESOPs and all of that they would have had to make the financials public anyway. So one of the Mag 7 delayed their IPO till they could. So, to me, that means that you should IPO a company only when you're ready. There is no benefit of going early. And I think the way you're thinking is probably the most mature, absolute, the right way.
And that brings me to my next question. In fact, if you think about it, what Pranjal was saying, the first point, right, about it being, debt bringing that discipline, credit bringing that discipline that you'd not have with a lot of equity, right? You can go on to raise $1 billion of equity, you probably will not have the same level of discipline that you get when you raise, let's say, $50 or $100 million of debt. So in a market where people have to decide when to go public, people do not have great or easy access to equity. How important is that we need to see more private credit players in Asia? Because currently, I think in the capital stack, I would say Asia is way behind, let's say, North America or Europe in terms of maturity, in terms of capital stack. So, and this is relevant not just for Edtech sector, but for the entire technology and other growth sectors. So how important is it from your perspective, number one? And Pranjal, for you as a person who has now dealt with few private credit funds, etc., you've also had probably the opportunity to deal with some of the US and North American funds. I don't know what we are, but yeah, we're somewhere in the intersection. But how do you then, I'd like to see your perspective as a company, how that experience was and how it can be improved. So I think that'll be good. Maybe we'll start with Kamal and then we'll come to you.
So as you think about private credit, it's just an alternative form of capital and source of capital. I think bankers and investors have this habit of complicating things by terming them fancy terms, private credit. Effectively, if you're a company looking for growth capital, you can take a bank loan, bank debt. At one end of the spectrum, you could go to the other end, which is raise equity. Could be public markets, private markets. I think as the markets have become more volatile, and as interest rates, not now, but call it a couple of years back, were near zero, there was a pool of capital which became quite vibrant and active, which is quote-unquote private credit, where investors could get downside protected capital being available to companies, but linking it to some sort of growth of the company or equity return, which made sure that the risk-adjusted returns were higher than zero, which is where, or near zero, which is where the debt was, but it was not near the equity return. The benefit, if you're a company, was it was bespoke, completely customized to your return, to your needs, customized to how your business was evolving, how your financials could evolve over the years, and that really then made it a win-win for investors and companies. To a scenario today where there's probably $1 trillion of capital available in private credit, you can go from early stage high growth companies to funding buyouts. And I think, therefore, it's a much needed critical source of capital across the cap table. And if you're an early stage company, you could go to a VC, raise equity. But as your business evolves, as your financials become more mature, as you get more discipline in your reporting, I think you can raise quote unquote dilutive capital from Mars growth without diluting equity. And I think that is valuable for the founders, that's valuable for management in a huge way.
I'll just add to that, right? I mean, you asked about the context between Americas and Asia. I think in Asia, we always had venture debt, at least last 7-8 years, right? So there was private credit available, and the venture debt would play typically in the early stage. What has recently changed, especially with guys like Mars, is A, the ticket size has expanded. So it's not the 10, 15, $5 million, it can be 100, $150 million. Two, the stage obviously has then progressed to growth stage. To ask the question saying, how was our experience when we were raising debt? And let me sort of add another point to that, which is a lot of traditional banks give debt, but they don't understand the spectrum well. They have their underwriting tools which will look at metrics, right? You know, are you already EBITDA positive? Okay, what is your DSR ratio? Okay, fine, I can give you 4 to 5x of your EBITDA. And to the point that, you know, Kamal was making, that's not bespoke, that's cookie cutter. But now we are seeing that bespokiness or customization is coming in, even with traditional banks, where they're starting to say, okay, you know what, we can be flexible in that spectrum. Our experience, you know, to be honest, the space was very limited. We ended up speaking to 4 or 5 credible players, right? And I remember our conversation that happened.
Our conversation was over coffee at one of the hotels nearby.
Yes.
Your favorite hangout place, yeah?
Yes.
Yeah.
So I remember that conversation very vividly, and I think the ability to customize is clearly one of the biggest things, I would say. Because I don't even see that flexibility in traditional private equity or VC also. I mean, that's fairly cookie cutter. So I think was one clear differentiator that happened. Obviously, ticket size is a big thing for us. There's also a flip side to it, and maybe I'll flip and say I'll become the moderator and you become the person addressing it. The flip side of this is that a lot of companies seemingly have also been destroyed by taking debt.
You should also look at Kamal, not just me.
And not just in the edtech space. Of course, there are edtech examples also, which I won't go into.
The $1 billion fiasco, Kamal. Okay.
So I think, and probably that's the question to you, right? So when somebody is looking at private credit, right? Today it seems like they need to have a lot of courage, not just at the management level, but also even at the board level and investor level. To say, okay, now we can take this debt, because in the back of the mind, everybody is worried that this can destroy value for everyone. So how do you ensure, or at least react to this? And what's your sort of?
I think at least when we started Mars, I was there from the beginning. Some of the biggest names in the market wanted capital from us, right? Obviously, having the name tag of a large institution like MUFG Bank helps. So that brings a lot of credibility. So you believe that, all right, the Japanese, they behave in a certain way, so they will not take your company down immediately. They probably will give you a notice and, tell you, we'll take your company down in 6 months. No, but jokes aside, most players, most lenders do what they do because I believe they think less like a traditional investor would. So, for example, as a lender, I'm always at a disadvantage because I don't sit on your board. I don't know what's happening within your company. I just have to rely on data that you would provide me. So if you are, smart and courageous, you can fudge your numbers. You can create fake bank statements and do different things, which definitely tarnishes the industry. But ultimately, as a lender with all these, let's say, handicaps, if you're able to make sense with the help of data science and technology, which is what we try to do at Liquidity, and I'm not saying we are experts at it, but we've been trying to do that. It always helps, right? It always helps for us to actually rate what is, in a bank's term, an unrated credit or a junk credit. So how do you rate a junk credit and then decide, all right, this company is losing money, but then this is not a bad credit actually. If you actually compare it to a company that has been making profits on a yearly basis, but then also discount for the fact that the company is growing in certain markets, doing this, doing that, being able to make sense of all that helps a lender to be more intelligent and do it. And this is something that we want to actually try and develop more and more and more and more, and that's what we've been doing. But of course, there are certain telltale signs, right? So for example, how is a company responding, right? The reporting that Kamal just mentioned about, the standards of the reporting. And I have to say one thing. Across all our portfolio companies, and hats off to Pranjal and team, they're one of the best in terms of their reporting, they're on time, they're transparent with the process, which always helps, right? And I'm not saying this because Pranjal asked me to, okay? I'm saying it for real. But actually, I think, many times lenders come to a stage where they don't know anything else to do but to enforce, or think about enforcing, or say that we're going to enforce tomorrow, and that's bad. And I think it's if you think about credit, it has been lending is one of the most oldest professions in the world. It's been around for 4,000, 5,000 years. Depending on your version of when the universe began or when man became man, right? So 4,000, 5,000 years, this industry has been the same. It's about, I give you money, you give me back, along with some, monthly or quarterly profit, etc., etc. So it has not changed as a profession, and it really needs disruption.
No, I will just add to that, right? Two things. One, I'll say is, lenders are not operators.
Yes.
So the last thing they want is to, become operators.
Yes.
And that's really, that's something that, we understand now that we build a relationship. I think And second, like you said, right, if you are building a transparent relationship, I've seen that, especially in the private credit world, uh, they can solve problems for you, right? So it's not like they want to be a problem and say, look, no, okay, now I'll just take your company. They'll solve the problems for you. They'll be flexible about it. So I think some of those myths still exist, especially when it comes to media. Of course, it gets sensationalized also. But I agree with you. I think as long as you are being transparent and having that relationship and, not giving us shock or hiding things or being unethical.
Kamal is being very quiet, I wanted to speak because, he has more to share.
I think you have run out of things to say, so you are pulling me in. So it's fine. So I would say, first off, there is no scenario in which the source of capital or capital can be held responsible for business cycles and how a business does, success or failure. Because effectively, capital is one of the variables in tools, which delivers change, which delivers growth, depending on how you use it. And to me, that's the key operative word, which is how does the company use capital? It could be credit, private, public. It could be equity, private, public. So I think that's one. Two, I think because in many ways private credit market are still nascent, most managements and entrepreneurs don't realize that the way a private credit investor thinks of a company is different from an equity investor. And at least in India, to your earlier point, entrepreneurs, managements have had more experience with private VC or equity providers. An equity provider is looking for upside. That's it. The first thing which Nawaz or a private credit investor will look for is, in a worst case scenario, can we take up capital and principal back? And I think that's a fundamental difference, which means as you then build a relationship with a private credit or debt provider, you need to probably invest more in that relationship in terms of transparency, sharing of data, reporting. And like it happens with humans, if there is a breakage in relationship, can it go to the extreme of separation? The answer is yes. So the same can happen if that relationship with a debt provider or a private credit provider is not managed appropriately. So to me, therefore, it's not the first time, it's not the last time where you would have had instances where a private credit or lender may have forced the issue because they just want the principal back. I think that's just probably the end result of a whole host of symptoms which existed in those scenarios. That will be true for India, that will be true for Asia, it's true for every other part of the world.
So do you think this is a problem? I mean, and I know that I'm maybe veering off topic a little bit, but in general, do you think with some of these stories, you're seeing lesser and lesser of those stories, or lesser and lesser of that behavior, or are you seeing, okay, this is just coming back, when the markets become stronger, the founders and the CFOs become more arrogant and say, hey, we are not giving you data, we wouldn't give you this. Is that something that you're seeing, or
I think so. Such instances do lead to, I would say, a right reset of the industry, both sides, which means the investors, credit or debt, or equity, start asking for higher diligence, which could be we need a minimum level of data to be able to get comfortable, a minimum time for diligence involving our advisors. I think the companies are becoming more careful to say we need to invest in our systems, processes, controls so that we can produce those reports for our investors, again, equity or debt, every month, every quarter. Let's have periodic conversations with our investors so that they get a feel of our business. Because finally, yes, there's always a scenario or a possibility that your business will go through cycles. When it goes through a down cycle, there is always a scenario where you could have conversation, get more time, restructure terms before you get to the extreme. But if there is no conversation in the middle, I think that's where things get aggravated.
I'll just add to that, right? Just taking the conversation in a slightly different direction. I think, in my view, private credit is opportunity in markets like India and Asia is actually very under leveraged, or just tongue-in-cheek comment, but yeah, very under leveraged. uh, I think like Kamal mentioned, the founders have traditionally had exposure to the VC private equity ecosystem. If you look at in India, um, I think late 1990s, early 2000 is when the VCP ecosystem in India started to evolve. And it's taken 2 decades to now everybody's sort of recognizing that as a default growth credit capital. I think the venture debt industry in India is only 6-7 years old. So I think it is going to take another decade for the ecosystem to realize that, look, this is a great source of non-dilutive capital with some added advantages of discipline, etc., all of that. And some success stories will get built based on this. And that's when I think, the ecosystem from the demand side will come in. What I'm not sure of is, and maybe you can add some perspectives there, what I'm not sure is from the supply side, is there adequate interest to provide private credit or debt in markets like India and APAC? Because US, we all know, like Kamal mentioned, it's fairly now standard. Are you seeing that when you were looking at raising funds, let's say from MUFG and other, are they now writing bigger checks? Is it really evolving as an ecosystem?
See, I'll tell you one thing. Providing debt in India is a completely different story from providing equity in India. Because I'd say, and Kamal can give more context on this, but I think for an international equity fund to actually give equity into India, it's very easy. For a private credit fund like us, that's international, for us to give debt into India and to perfect it, extremely difficult.
Why?
Because of regulations, I would say right now. Of course, there are regulatory mechanisms to do this properly, but there are also commercial considerations, what is the returns, etc. But Kamal, maybe you should also, talk about that point a little bit.
So I think that's accurate. One, it's the ecosystem is evolving. I think the depth of supply on the investor side is still maturing. At the same time, I think in the last 12 months, the universe of people who have come in has increased dramatically. So if you think of buckets, and there are traditional institutions like MUFG Mars who have come in, there are some of the larger US-based private equity funds, buyout funds which have come in. Think of Blackstone Private Credit, think of Apollo, think of Varde. These are amongst the largest debt private credit providers globally. As that ecosystem matures, I think the terms and conditions package and assessment of risk in the country will also evolve. Because finally, I'll go back to the point I made, which is for a credit provider, the biggest thing is, in a worst case scenario, can we take our principal back? And as we know from the Indian context, Indian banks, including public sector banks at times, have struggled to get their principal back. So in a way, that regulatory environment has evolved meaningfully for the better. And it's getting to a place where some of these larger global institutions are getting comfortable. But I think if you fast forward 5 years down the line, at least our view is that the private credit, private debt markets will be as vibrant as the VC and private equity markets, without a doubt.
Yeah. I think also we need to think about how the commercials will evolve, because I think, once you see stronger and stronger companies, the expectation in the market is also to get cheaper and cheaper capital, right? But that's not always the case, when it comes to actually these private credit funds, because these are basically off-balance sheet vehicles. You know what I mean? And banks expect more returns on that capital compared to their balance sheet capital. So obviously, commercial considerations will also drive how much capital comes into the market. But Asia in general, I would say, you have some very vibrant markets like Singapore, which is very international. So, Indian companies with growth ambitions globally, like Edtech Emeritus, You obviously have a lot of opportunity to raise capital from global lenders who can actually lend in jurisdictions like Singapore. I know that we're probably coming in terms of time. I don't know where we stand, but I would really like to understand. You've been one of the You've been an investor in Eruditus, and that's how you started your journey. And then now you're the CFO of Eruditus. Walk us through that a little bit.
Okay, so that's not a
How's
question.
that not insider?
That was not a question I was expecting in a private credit discussion. But yeah, no, look, I think, let me take a step back. I think it's important for an investor to understand operations. To your point, a lender can afford not to do that and rely on it. But I think as an investor, that was always one big consideration. And I think that sort of drove me. Of course, I knew the founders well in advance, and I knew that there's a frequency match and there's a mission match, and the leadership was obviously as gray-haired as I am, so so that helped. But to answer your question in the context of this discussion, I think one thing as an investor I always valued was information flow coming from our portfolio companies, right? And I was managing the portfolio also for the corporate VC. So that was extremely important for us, number one. Number two, I can say this with a sort of tongue-in-cheek comment that investors are usually very high level, right? But they do have certain signals from the world that they see around.
Define high level.
Right? So you may not get a specific advice, but you will get directional inputs which can be meaningful. And hence it's important to build a relationship, to at least pick those signals, and then decide as a management what you want to do, what you don't want to do with it, right? So as I look at that, and then...
So did you ask Ashwin and Chet too many questions and they said, you know what, you come and work for us, answer these questions yourself?
Yeah, so they're around here, you can check with them and they'll tell you. But there's a reason I'm still here for 5 years. But I think the bigger point I want to make is that as a CFO, for me, the important thing was to focus on the IR part of the CFO as well, which is ensure that you give the information as transparently as possible, as frequently as possible to the investors, because that informs their thinking, and then that helps in engaging them. And then you can pick some signals from them, right or wrong, and then decide which ones are the ones that you want to take and which ones are the ones that you don't want to consider. So I think that is something which I think as an investor helped me in my CFO journey.
Now coming back to the question we agreed previously behind stage, are VCs better or private credit lenders? There's only one answer. Huh? There's only one answer.
I would go with the diplomatic answer that Kamal gave, that capital is capital.
Absolutely.
Okay, I don't want to sound cliched, but I think there is a right kind of capital for the right stage. If you would have asked that question when we were Series A, Series B, I would have said, no way, VCs are obviously better. There's no doubt about it.
Now I have to start thinking about...
I think you pushed your luck too hard. You got right answers till now. You had to kind of not ask that question in the end.
So anyway, I wanted to come to you, Kamal, for something that is, I think, more serious, on a serious note. India and its development. So the topic of this entire session summit is all eyes on India, right? And Emeritus has been one of the shining stories of this Edtech, education story. But as a sector, let's talk about education as a sector, as an industry, as a sector. How important do you think it is for the country and its growth and development in future?
Sure. I would say as you think about India, we have, pick a number, anywhere between 30 to 35 million babies who are born every year, which is the highest on this planet. As you think about probably all of us in this room, the primary reason we are where we are is because of the education imparted to us for which our parents really worked hard. And I think that's culturally ingrained in us, which is, for me, providing the best quality education to my children is top of the list, which means it is, in my expenditure bucket, probably the only non-discretionary spend. And I think that's true for most Indian parents, metros to the villages, that they'll sacrifice on each and every category, but not education. If you then combine everything and think of India as, call it a 5 trillion economy, 5 trillion market cap listed economy, there is not a single high quality education company listed. Whether you're, whoever you are, provider of capital, equity or private credit, finally your end goal is that the company to which you have provided capital has a great listing. To me, there will be in 5+ years many high quality education businesses listed because they are solving for probably the biggest problem which exists on earth in this country. And I don't think there is any other sector which is solving that problem at that scale across sectors.
I'm mindful that the bell has rung. Before they kick us out, I want you to say, follow-on comments, how you see Emeritus building on this, probably education being one of the cornerstones for India's development.
No, so again, look, just to recap for this group, about 75% of our business is outside India today, right? 25% odd is in India. But we are seeing significant opportunity in India. My India business is growing at about 37% year on year. So clearly, to Kamal's point, there's a big opportunity here. I would also sort of back Kamal and say, yes, one of the companies will definitely get listed in the next 5 years. So we do have plans for that also. What I would just add, sort of maybe differentiate with Kamal is that I have not seen, I'm still seeing a lot of smaller subscale education businesses in India. So probably there's a need for somebody to come in and say consolidate, grow. So there are a lot of these smaller, great companies, profitable, all of that, but they are subscale. And I think that is something that, somebody will have to solve.
You're ready for more consolidation?
I don't know
we don't have time, so, but that's for another session.
That's for the other session.
But thank you very much, both Kamal and Pranjal. It was at least I enjoyed this session. I don't know how many of you enjoyed it. But then, as I said, we started off well, insider trading, good conversation, acquisition, definitely we should talk more. And yeah, any final comments? And we can, before they kick us out? I didn't ask them to say this, but yeah, I'm going to give both of them candies for that.